Hi, and welcome to the Midday Market update for January 26, 2021. My name is Kevin Hill, as always, here with Michael Vincent as we take you around the freight world, the news, headlines from FreightWaves.com, and the industry leaders. How are you doing today, Mike?
I'm doing great, Kevin. Welcome, everybody. And our interactive show. So we'll be on LinkedIn, FreightWaves LinkedIn and Facebook. So get your questions and comments in there. We'll get them addressed and answered as best we can. But we've got a pretty good show as always. There's some interesting headlines, right, Kevin? We got some Kyle Lintner in the house again from K Ratio, and who else do we have? Chris Seeds here as well.
Chris Seeds, yeah, Chris Seeds, Trailer Bridge coming in. We're going to talk a lot about the domestic freight, truckload market today, and seeing what Q1 2021 is bringing in store, and kind of what our expectations and forecasts are for volumes, capacity, and rates going into this new year. There's a lot of uncertainty out there, but we will go through that. And we also have our own director of freight market intelligence, Zach Strickland, that will be joining us to give his take on the freight markets as well. And our lead economist, Anthony Smith, will join us talking about economic conditions out there. And Nick Austin, as always, with the weather. But we can start off right now with our own Andrew Cox talking about the top headlines from FreightWaves.com. If you're not a subscriber to our newsletter, go to FreightWaves.com and get subscribed for that. They come out about right now, right at noon Eastern time every day with all the top headlines. And we have an acquisition, TFI, buying UPS Freight, the LTL part of UPS, that came out yesterday. We have some really great material on there. What do we have, Andrew?
Yeah, we've got a few stories on FreightWaves.com on the topic. This one by Mark Solomon. New UPS CEO Carol Tomé has pulled the plug on the company's 15-year, often difficult foray into the LTL business. On Monday, UPS announced the sale of its LTL division, UPS Freight, to Canadian-based TFI International for $800 million. The deal has been unanimously approved by both boards and is set to close sometime in Q2. The move reflects Tomé's belief that LTL was not, is not, and never will be a strong strategic fit for the company. Tomé has only been CEO since June, but she is not a newbie to the company. She is quite a veteran. She was there 2 years prior to UPS's acquisition of overnight transportation for $1.25 billion in 2005. That was rebranded into UPS Freight. Satish Indel, president of ShipMatrix and SJ Consulting, believed UPS never seemed to be serious about its LTL business. He said the huge tech investments that the company made never seemed to trickle down to its LTL division, which is in desperate need of digitization. The integration to overnight and UPS was fraught from the very start. The ink was barely dry on the transaction when UPS executives descended upon overnight's Richmond, Virginia headquarters and began making immediate changes. People around UPS and overnight at the time said that UPS tried to apply its parcel-centric learning to the LTL business, but very quickly learned that the two businesses were quite different. The operational integration moved slowly. There never seemed to be a great cultural fit. And UPS did maintain the headquarters in Richmond, but it seemed that the unit operated on a different wavelength than the rest of the UPS organization. From an operational point of view, UPS Freight has struggled to keep its costs in line, and that's been apparent in the recent operating ratio expansion. In 2014, the OR sat at about 94%, but since then has just steadily increased to the most recent quarter, notching at 99%. TFI will have to walk a tightrope over the next several quarters. It wants to bring down that UPS Freight OR towards its very impressive 85% OR. But the company does have a very strong and impressive track record of acquisitions. It's made more than 90 in the past 12 years. But you got to think that this is a completely different animal for TFI, much larger than any acquisition they've ever made. This acquisition of UPS Freight, the revenue that it brings in is $3.15 billion for 2020. That's 82% of TFI's revenue, so more or less doubling in revenue size. But the workforce increase is what's most incredible. They're going to add about 14,000 employees, going from 2,000 to 16,000 as a new company. So a lot of integration to do, a lot of cost savings potentially, but it's going to be a tightrope to walk. Kevin.
That is a tightrope. I mean, there's a couple lessons there. I mean, number one, it's a union shop, which we'll have a bit more about later on into today and tomorrow on FreightWaves.com, talking about that. But it really really tells you that it's much different businesses. Parcel to LTL to final mile to full truckload, they are not quite as similar as a lot of people believe, and that they all have their challenges. It's hard to integrate, right, Michael?
Yeah, it absolutely is. It's really interesting. I was born in the LTL world. First 12 years of my career was in LTL. And, at that time, you look at FedEx package, et cetera, that came from the spinoff of Roadway Services from Roadway Express, as we like to think of it. Those of us that stayed at Roadway Express, we spun the rest of them off, right? But from that came RPS, which was the parcel and package, Roadway Parcel Service, package services, right? And we never tried to marry those, never tried to bring them together at all. But when UPS bought Overnight, it was very confusing to those of us who lived through that spinoff. That would be difficult. Now, TFI, they already know how to do LTL, right? They've already proven themselves. It's just as you point out, and the article points out, Andrew, can they 8 multiple their size and do it successfully? I know a lot of guys over there. I think they will.
Yeah, they're adding a lot of facilities here too. I mean, they're adding, I think, 197 facilities, over 50 hubs. So 147 of them are owned by UPS Freight, 50 are leased. So you're adding a huge number of workers and a huge number of assets to the portfolio. So I'm excited to see how TFI handles it over the next 12 to 18 months.
I can just imagine Michael Vincent being wrapped in a blanket on a dock in the LTL world, being born into the LTL world.
Yeah, on a Toyota forklift on Hagman Road in Toledo, Ohio.
So we talk about the West Coast ports quite a bit, but we have some news today from Kim Link-Willis about the East Coast ports, the Georgia port in Savannah. What do we have there?
Yeah, Georgia Ports Authority Executive Director Griff Lynch described 2020 as the year of the low of lows and the high of highs. Those highs helped propel GPA to move more than 4.68 million TEUs for the year, an increase of 1.8% year over year. Lynch said, "When I think back to where we were during the July timeframe, I would have never expected or anticipated that we would come out positive year over year for the annual number." In Georgia, in October, they broke the port's all-time record. And then in November, they broke that record. So Lynch and the Port Authority thought if December comes in strong, they may have a chance of coming in positive after an extremely weak February, March, April, and May. Then the December came in even stronger than November. TEUs came in 24% up year over year. And Lynch is expecting a strong January as well. Not quite as strong as the last 3 months of the year, he warned, because those last 3 months of the year made up the greatest quarter in the Georgia Port Authority's history. But he still is expecting double-digit growth throughout January, which he sees as extremely impressive, given that it is a typical low time for freight. He said right now they're running at peak constantly. He also said there hasn't been a lull. He hasn't seen one, and he doesn't expect to see one at all this year, pushing volume straight through Lunar New Year. He's even expecting strong volumes into April and May. Kevin?
Yeah, it's going to be a strong season, at least initially, just like on the West Coast, right, Michael?
Yeah, it certainly looks like it. And as I was reading this article and looking through this, and we've seen the stats as well, it's interesting that if you didn't know what happened this year, you might think this is believable anyways, with the expansion of the super tankers or the larger ships and being able to get through the Panama Canal and the dredging of the waterways into these ports, the expansion of these ports, and the changes that have come with sourcing around the world with the different tariffs that went into place in the last administration, right? You'd believe that they might be hitting these numbers even without the pandemic. You know what I mean?
I know what you mean, definitely. And so you have that. Let's go to our next headline there, Andrew Cox, and talk about drones. Everyone loves to talk about drones, so let's talk about drones now.
Yeah, we've got some funding news for Wingcopter, a German-based developer and manufacturer of unmanned delivery drones. They've secured $22 million of huge Series A funding round. The company said that the money will be used to scale out its healthcare-related applications, including the drone droppage of COVID-19 vaccines. Jonathan McQueen, co-founder and managing partner of Explorer Capital, who led the funding round, said, "We look forward to watching and supporting them as they help deliver vaccines in the near term and deliver freight in a more sustainable way in the long term." So you can see where their eyes are on the prize. Wingcopter is involved in a COVID-19 project in Malawi, a landlocked country in southeastern Africa. The project involves Wingcopter partnering with UNICEF's African Drone and Data Academy to train local youth in drone operations. In an interview with Reuters Monday, CEO Tom Plumer said that COVID is changing the acceptance of drones. COVID is making it necessary to build everything fast, but he still believes there's a whole new infrastructure that's going to be needed to be built out to carry things like medication, blood, and lab samples. The Wingcopter 178, their new helicopter, their new drone, has a top speed of 93 miles per hour with a cruising speed of about 62. The range is dependent on the payload, with the drone able to carry a 8.8 pound payload about 37 miles and is able to go 74 miles when empty. The maximum payload is just under 14 pounds. In addition to the expansion in its healthcare programs, Wingcopter is going to use some of the proceeds to help set up a serial production near its German headquarters to help grow its team of flight testers, secure some certifications, as well as increase software development and expand production capabilities, which is expected to include a production facility here in the US. Michael.
Yeah, it's interesting to me to see that where this is going. I love drones, Kevin and Andrew, and I love the possibility of their use and the way they're being utilized in this type of instance, as well as just commercially around delivering pizzas, et cetera. I think it's pretty cool. I think this is kind of like when you look at autonomous vehicles or certain places where they will come into play and be utilized first and should be. Here's a perfect example. You're looking at these UNICEF's African drone usage in delivering COVID and other medical supplies into places that don't have the infrastructure as you do in the United States, which kind of lends itself to the acceptance of drones faster than some place that has built up infrastructure that almost inhibits the proliferation of drones a little bit. Andrew and Kevin, if you know what I mean, in the U.S., it's kind of difficult because we already have the infrastructure. Does that make sense?
Yeah, I understand what you're saying, and I definitely agree with you in the set of circumstances where it's ideal to use new technologies. For example, you mentioned autonomous vehicles, drayage operations or, hub to hub middle mile services. Those seem to be the ones that are attracting the most interest from autonomous vehicle producers because they're the simplest, they're controlled. And you have similar things here for this, and you have a really specific need that needs to be met that can't be met in any other way. So you're right, it does expedite the process. We don't have that desire and that need to push forward as fast in the US because we could put it on an airplane or we could put it on a train. There's many other ways that we could get it there that these remote locations, these developing countries just don't have. So you're right about that, pushing forward the production cycle and the approval cycle. And you're also right about it having specific use cases.
Yeah. I mean, as cool as it would be to have a 6-pack of beer delivered to me during my next pool party in the spring, while, people are over after we can social again, it's not necessary, right?
It is not. So we have Chris Seeds is already here on LinkedIn. Of course, Dooner's on here. Nico Brown, Rhonda, the whole gang is in here talking about Andrew and Bernie memes. So what that really means, I don't really know, but let's go. Andrew, you do point of sale, every Monday and Thursday, your newsletter you send out. What is cooking on the retail supply chain right now?
So yesterday I had a few stories. I'm going to highlight one for you. It is about the Instacart layoffs. So everyone is looking at the recent Instacart layoffs of 1,800 people for the union squashing angle here. So yes, Instacart laid off 1,800 part-time workers, and a handful of them happened to be the only workers that had ever attempted to form a union of the Instacart workers. But I see a much better story, and it's the reason for why these workers were laid off in the first place. And it happens to do with the way that grocers are adjusting their relationship with Instacart. So as these grocers have rolled out BOPIS, curbside, Albertsons is even testing temperature-controlled lockers out some of its stores in California. They're doing many different things to fulfill online grocery orders in different ways, in more profitable ways. Grocery is a notoriously low margin, high volume business that can't afford to subsidize delivery like, say, Pizza Hut or Domino's or Papa John's can with their high margins on a pizza. Instacart has two types of workers. So they have more than 500,000 contract workers that either deliver goods, that pick goods from stores and deliver goods. But they also have tens of thousands of part-time employees who do receive benefits from the company, can even accrue sick pay. These part-time employees are stationed in a particular store. So these second types of workers are the ones that are being laid off by Instacart. So Kroger is the latest to make this move, and Aldi and Sprouts made the move last year. But now all three are taking company employees to fulfill the orders in store for either pickup or rapid delivery from another Instacart contracted worker, but not that part-time worker. So from a customer perspective, there's absolutely no change. I'd still get on the Instacart app. I'd either order to pickup or I'd order delivery. It would be the same method for me. But the company is able to eliminate the Instacart workers from inside the store and therefore eliminate those costs as well. So retailers are getting smart about fulfillment methods. And it's and last year, for over the last year, it's been an expansionary mode for these grocers as they roll out BOPUS and they roll out all of these different things. They make huge investments as they try to fight for market share. And it's a really valuable market share. The grocery industry is a $900 billion market. Every 1% that goes online is $9 billion in sales up for grabs. I have a chart, if it gets shown here, that is from Bank of America on the percentage of spending that's done online for three different segments. You can see that online grocery started at a much lower base, less than 5%, but it's now almost tripled to about 13% of total spending. So billions and billions of dollars has shifted online. Market share opened up for people to take advantage of. So grocers are going to look for returns on those investments that they've made on BOPUS and on all these different fulfillment methods. And they understand their economics are just much better if they do it with their own employees fulfilling the orders in stores. So look for them to be incentivizing shoppers to utilize pickup options so that they can more quickly transition away from these costly third-party partners like Instacart and others. Fellas.
Andrew, do you think, we've seen huge gains in home delivery of groceries during COVID. Do you think any of those gains, once COVID's over, the pandemic's over, do you think any of those gains will be given back on that, or much slower growth in the future on really grocery delivery?
Well, I think, there is a certain level of grocery delivery that will be here to stay. There's some people, especially those that have gone in on a Walmart Plus partnership that's signed into a yearly subscription. Amazon is rapidly growing with its Amazon Fresh boxes as well. But I do think, and I've seen some research recently, that the people that are buying online groceries are more often opting for a grocery pickup because they're ordering from the store that's already close to them. They're either ordering from the Publix they would typically go to, but they're just picking it up curbside, or they're doing it at the Walmart or whatever store is close to them, but they're just picking it up curbside. So I think that is what's really here to stay. I mean, grocery delivery, some people will be able to afford that and will be able to pay for it. But what's going to happen is these retailers, these grocers are going to roll back their subsidizing of the delivery, and they're going to try to incentivize people to pick up from the store. And it's a really good value proposition to customers because we were already going to go to the store. It's already within our reach. It's just a stop on the way home. But now that time spent in there has been reduced by an order of magnitude. So it's a really good value proposition for both the consumer and the retailer, who can reduce store count, they can turn over product faster. I think we're going to see more focus on BOPUS and curbside and those investments that they've made over the last year, finding ways to utilize those even more.
Yeah, Rhonda says here on LinkedIn, our grocery stores reallocated about 8 to 12 parking spots for pickup services. There's more pickup spaces than handicap spots now. So I know it's really grown, and that's normal now. I mean, every grocery store, every big box retailer that you go to now, there are dedicated spots there on front. Restaurants as well. Restaurants kind of started at curbside service even before the pandemic, but now you're seeing that in all the brick and mortars.
Yeah, there's one company that has not bit the bullet yet, but that is just dipping its toe in, and that's Costco. So I just heard word yesterday that Costco has begun offering curbside servicing and trialing it at 3 of its New Mexico stores in Albuquerque. So these are the only stores in the country or in the world that Costco has that provides curbside pickup. They've been so reluctant to do it because they just haven't needed to do it. They have an insatiable demand for store traffic, for people coming in. So they haven't felt the need. Even as close back as December, they said that they would never do something like this. But now they are trying it out. They've seen Sam's and BJ's Wholesale, the other competitors, roll out similar things to great success. So they're finally biting the bullet. We'll see if they end up going full in on it. But they have designated about 15 parking spots in 3 of their New Mexico stores to run curbside.
Very interesting, and it'll be interesting to see how it develops for those items and those businesses that count on foot traffic in those stores, right? I mean, there's specific end cap displays and product placement, and it really hit me kind of in the brain when you're talking about Costco, because you walk into a Sam's or something like that, and you got to walk back past $400 plasma TVs in order to get to the 5-gallon jugs of mayonnaise and so on,
Yep.
and it's built that way. You
Yes.
can't really. It's hard to do that online, right?
Yes, it is built for product discovery. And that's one thing I actually do expect to see more of in retailers. I don't think this will be an overnight shift, but you got to think about the way that Americans shop online. We are not browsers. We go online with the idea of searching for exactly what we need. Our whole idea of e-commerce is built around the Google search bar and the Amazon search bar. But it's not like that everywhere. China has a huge e-commerce business for just social browsing and buying things that you go online not knowing what you want to buy. So I expect retailers to be creative in the ways that they can get more people just to browse. I mean, Amazon doesn't do this so much with browsing. They just say, other people that bought this also bought things like this. That is a way to add the end caps on the end of the aisle, so to say. But other companies are going to do something similar.
Yeah. Give me a pair of Oculus. Is it? I mean, the virtual reality, right? And I'll go shop online.
Yeah,
if it's an electronics store, guitars.
Yeah, right. There's a lot of big
I
moves
still like going
in AR
inside.
and VR. Right now, I just saw Pinterest roll out new art. It's not for the Oculus; it's on the cell phone. But that's another thing. This goes back to my 5 retail predictions I made at the beginning of the year. That I think that more people are going to be focusing on that pre-transaction side of the returns process. AR,
Absolutely.
VR, imaging, all the descriptions is just parts of that.
Great. Thank you very much, Andrew. And how does our audience go on and subscribe to your newsletter, Point of Sale?
Yeah, it's pretty easy. You can just go to freightwaves.com/POS to sign up. I give out retail news and insights 2 times a week on Mondays and Thursdays. Check it out.
Will do. Thank you very much.
Thanks, Andrew.
So in Chattanooga yesterday, it rained, and it rained, and it rained.
Certainly, yes, it did. And then last night it rained and rained and rained again.
It rained. And now it's nice and sunny, not a cloud in the sky, which is great. But let's check in with the weather. I think there is a snowstorm going through the Midwest up into the Northeast right now. So let's check in with Nick Austin and the weather.
That's right, guys. We have a doozy of a snowstorm heading to the Sierra Nevada over the next few days and other parts of the Mountain West and the Southwest, too. It's not just going to be in the Sierra Nevada, but that's probably where we'll see the most snow and the worst conditions for truckers out there. So let's get right to it. Sonar Critical Events Map. We're talking about this region right here, a very, very broad area across California, the Sierra Nevada, into a good chunk of Nevada as well, parts of the Cascades, Rockies, Utah, down in the Arizona. A lot of the high elevations in these regions will see up to a few feet of snow. However, Sierra Nevada will see a lot more, and we'll get to that in a moment. But the storm is going to enter the west coast this afternoon and then spread eastward slowly over the next few days. This will not be a quick hitter. This is going to cause problems for the next few days, maybe even into the weekend as another storm follows this one. But the Sierra Nevada along the I-80 corridor from Truckee and into the greater Lake Tahoe region, Carson City, Reno, those areas as well in the high elevations, US 50, US 395, all these roads are going to be big trouble. 5 to 7 feet of total snowfall in these areas on the high elevations through Friday, from this afternoon through Friday afternoon. Those are big, big snow totals, even for this area from one storm, because it's going to stick around for a few days. It's not going to move through quickly. A lot of wind, too, in the Sierra, 60 to 80 mile an hour winds possible. As far as gusts, there'll be whiteout conditions, likely a lot of road closures. So any truckers trying to get through this region are probably going to get stuck in a lot of spots. Just avoid it if at all possible. Also in Northern California, areas like the Mount Shasta region, and even down into the Sacramento Valley, parts of the Sacramento Valley, like the high elevations around Red Bluff and Redding, places like that could see up to 1.5 feet. Up towards Mount Shasta in those regions, that region could see at least 3 feet. So big, big problems. And as I mentioned, parts of other mountain ranges like the Wasatch, the Cascades, the Rockies could see up to a few feet as well. So problems, lots of problems with snow, wind, and it's going to linger for the rest of the week. Now, coming up later in the show, I'll have a recap of the weather And we'll talk about a few more of America's scariest bridges for truckers.
Thank you very much, Nick. Did I hear
Wow.
him right, Michael Vincent? Did he say 5 to 7 feet of snow?
Yeah, he did, and I immediately I'm going to get out my K2s and wax them up and go hit some fresh powder, bro. You with me? I mean, 7 feet of fresh
I
powder,
might.
dude. Yeah, that's
Have
some.
you ever been anywhere
Oh
where it
yeah,
snowed 5 to 7 feet?
a little over 4.5 feet in Utah at Snowbird.
Wow.
Yeah, hitting the upper bowls. That's chest, almost chest deep. People get their snorkels out.
Yeah.
Yeah, you
Yeah.
can
No,
throw some pretty. Yeah, you can throw some pretty mean rooster tails in 4 feet of fresh powder. So yeah, that'd be sweet. That'd be fun.
well, there you go. You can just go out to the Sierra Nevadas there in California and do that this week.
Who's with me?
Well, let's check in with Zach Strickland, our director of Freight Market Intelligence, and check out and see what tender capacity is doing. It's been trending down a little bit lower coming in January. Let's see what the trends are right now, Zach.
Hey guys, so outbound tender volumes did something very interesting here over the last week or so. It formed a seasonal pattern that we haven't seen in over a year. That's where basically the tender volumes kind of dip down in the third week of January and then come back a little bit. We typically see about a 3 to 4% drop in tender volumes occurring right around January 20th. This time it happened a little bit sooner this year. And of course, a little bit more exaggerated because that's just the freight market that we're in right now. They did, however, bounce back. They came back up about 4% after dropping 5% right around January 17th. So we thought the market was going to be in this kind of, it's going to return to seasonality slowly as these volumes probably will start to recede at some level. But it is interesting to still see some of these seasonal patterns, especially the third week of January pattern, still so persistent throughout this volatile market that we're in. Now, what wasn't seasonal about this was the fact that tender rejection rates did jump up about a 0.5 percentage point yesterday. Tender rejections tend to slowly crawl down throughout January and February before bottoming out and then getting a little bit more volatile around March. But yeah, it was a little interesting to see tender rejection rates jump back up over 21% or near 22%, or they were right around 21.5% for the most part over the weekend. And you know, the fact is that this market is going to probably have some of these intermittent jumps, bounces here and there. 21% is still an extremely high tender rejection rate. So capacity is still significantly, tight across the United States. Now, where some of that tightness is persisting is interesting because we're seeing, for instance, Los Angeles, start to retighten a little bit after having this precipitous decline in tender rejection rates. The West Coast, again, one of the tighter areas, or becoming one of the tighter areas of the country once again as they start to increase. But Allentown and Harrisburg up there in the Northeast have a little bit to say about that as they have the top spot on the weighted rejection index this week, which is a measurement that combines tender market share and tender rejection. So basically just saying high volume market, tightness is increasing more rapidly in this market versus some of these smaller markets due to the volumes and the sizes there. So Allentown, Los Angeles, the two corners of the country, still the most active in the United States this week.
Well, the trends continue, Michael Vincent, and we will be talking about domestic truckload with Kyle Lintner coming up in just a second, and Chris Sees as well. So we are going to get deep into the weeds, I think.
Yeah. I think let's hear from Anthony right now. We'll dig into what Zach was talking about, and with Kyle, we'll get some good insights there with Mr. Lintner. So, what's Anthony got for us?
Hey, Kevin. Hey, Michael. So today we're going to talk about a theme that we touched on last week, and that's housing and construction. Last week, we talked about new builds with housing starts hitting highs. Now we're talking about existing home sales, which makes up a much larger portion of the housing transaction market. We're looking at existing home sales. It's going to be around that 85 to 90% of that market when we're looking at housing transactions. And what we're seeing is unprecedented levels not seen since 2006, really. So over or just around 14 years. And we're looking at that year over year sales are up 22% when comparing it to 2019 overall. And those prices are around 9% higher than 2019 overall when we're looking at a year ago levels. This is putting the median home price just around $296,000 for that price point. And really what's pushing all this up is going to be those extremely tight inventory levels. We're looking at existing home sales, especially at entry-level and mid-level homes. Things get a little bit more freed up when you're looking at those price points just above 750,000 and higher. Not a lot of tightness there for inventory, but when we look at lower level homes, mid-level, entry-level homes, there's extremely tight inventory levels there. Now, the thing that we're going to be also watching, of course, is those extremely low, historically low mortgage rates. But the other thing is going to be those mandatoriums that have been put in place for eviction protection. So foreclosures, unfortunately, going to be a possibility when we're looking at that June level or mid 2021. When we look at executive orders put in place, there are protections put in place that were set by Congress already earlier on in the year to extend these benefits for those eviction protections. So that's unfortunately going to be an area that we're going to have to watch closely as we get closer to that midpoint of 2021. But as of now, extremely tight inventory levels. But that's going to really wrap it up for the existing home sale market. We are still seeing that there's going to be momentum moving into the 2021 year, especially when we look at new home builds. Permits are still at a high. We're still going to be watching Midwest and Southern markets really kind of increasing on that population level, especially as we see more and more individuals leave those California, New York, those larger metropolitan areas as they adapt to those work from home lifestyles. The other thing that we're going to be watching closely, of course, those initial jobs claims and employer conditions, consumer conditions, I should say, that's going to get released on Thursday. So that's going to wrap it up for today's econ quick update for the Midday Market update. Thanks so much, guys, and back to you.
Thank you very much, Anthony Smith, our lead economist here at FreightWaves. I tell you what, the housing market is just on fire. Won't stop, can't stop, or can't stop, won't stop. It'll just continue to power everything along, right, Mike?
Absolutely. And, Duna was out in my neck of the woods about a week ago on Friday. And by Sunday, the two houses right here that he was looking at were both under contract with somebody else. So, yeah, it's fast. You see it. 22% up year over year, 9% spike in pricing, unprecedented level since 2006. I remember 2006 was pretty crazy right before the burst.
Yeah, right before the bubble burst, right? So
yeah.
Well, let's talk about contract pricing, spot pricing, freight with our good friend Kyle Lintner here at K-Ratio. He's on here right now. How are you doing today, Kyle? Tell our audience a little bit about yourself, K-Ratio, and what you're seeing in the freight markets.
I'm doing well. Thanks, Kevin. Mike, nice to see you as well. Guys, brief intro. I'm the managing director at K-Ratio, the risk advisory firm that offers solutions for both revenue and expense risk, regardless of your category type, shipper, carrier, 3PL. To get at your question, Kevin, the one thing that was concerning me, it's a little bit similar to what Zach was saying. Yes, right now the most important markets are Harrisburg, Allentown, East Coast, and LA on the West Coast. But I think the most important thing that's happening inside of all of freight right now is contract rates are on fire and they are rapidly catching up to spot.
You had said, I believe, 15%, 10 to 15% on your Monday update that you did this week. Is that right?
Yeah, we're up year over year, 14% now from Jan 20 to Jan 21, which in and of itself is a huge move. But now when you compare the contract rates to the spot rates, which I think is paramount for anyone in the industry to do, because for whatever weird reason, and we don't need to get into that today, we have two markets. We have a spot market and we have a contract market. And if we now have contract rates that are catching up to spot rates, that's going to be a big magnet for where loads go. If you're a shipper, you'd prefer all of your stuff to go contract. And now if it's going at a contracted rate that's exceeding the spot rate, well, there really isn't a reason for it to go spot. So those loads are automatically going to go contract, which frees up a lot of capacity and increases the efficiency across the entire domestic supply chain. That has serious implications for intermediaries. If you're a 3PL, the relationship between spot and contract is a major driving force between not just profitability for your company, but how much overall business you guys are going to do.
Yeah, it absolutely is it's a severely driving force right now, right? So, yeah. So is this catch up gonna does it stick? I mean, how does it uncorrect itself if this is a correction, or let's say, how do they diverge again, right? Because they're basically converging, right? Because contract is to meet where that was elevated. So as that elevates, and then I guess who starts the ball to start bringing back down the spot rates? Because I would imagine that spot rates dropping severely would be the thing that would unwind this, right?
Right. It's a little bit of a chicken and an egg scenario here, but as contract rates move higher, and a lot of this unfortunately is anecdotal, you hear whispers of mini bids, rates on file, things like that, or even RFPs being moved up in the annual bid cycle. Those are the things that shippers need to do. Nobody wants the loss of productivity by their workforce routinely running out loads that just get rejected. When you have a load that rips through the entire routing guide, that doesn't do anybody any good. So let's just move the rate higher so we can get the stuff out the door, because it's going out the door no matter what. But now, if those rates are higher, you eliminate the need for the spot boards. Now, the truck companies that are still running spot loads from a broker, it's not going to matter to them, even if it is spot or contract. They're always conducting business with that broker as a spot load per se and at a spot price. But now, if we have loads that are going through contract, we free up some of this lost productivity by way of hours spent tendering, retendering, trying to source a truck. It's easier just to run it out through the routing guide. So I don't know if you want to call it a correction or an overcorrection or an undercorrection, but we need to have spot above contract. That's how this marketplace works. When it isn't like that, when it's out of balance and spot rates are higher, well, now we have all of these people that need to reprice and resource trucks just to get the loads out the door. Now, what's going to happen from here isn't going to happen overnight. This is an average, and on average right now, the difference between spot and contract is only 2 cents. But market by market, we'll begin to have these corrections. And I pointed out on Monday, if you look at just the biggest ones, and obviously the first one to go to for any of this stuff for me is always LA. Take a look at the LA outbound markets, and all of the primary destinations now have contract rates over spot rates, whether that's Dallas, Phoenix, Las Vegas, Stockton, Denver, Salt Lake City, you name it. If you now have a contract rate that's above your spot rate, business is going to flow pretty easily. And we're still going to have spot business because things are going to pop up and there's going to be excess volume on one day, or a truck really won't make it the other day. But if the course of action is just to run it through the routing guide like everybody prefers, that's going to calm things down. And I think it's going to look more like a domino effect of price, how we saw in the past, where one market gets hot and that creates a chain reaction in rising spot rates. We're now going to see markets cool off, and that'll have the chain reaction as far as which markets go next.
Yeah, we're talking about this. Actually, Chad Holsey from MTM says, good morning, and Marley Olivier says hi as well. So if you're a 3PL freight broker out there, and your most of your business is in the spot market, are you going to see less volumes come through to you in the spot on spot loads?
100%.
Because it's been a gravy. It's been gravy over the last 6-9 months on the spot market. Spot loads are everywhere. Yeah. Are you going to see a significant downturn in volume going into 2021 from spot loads from your shippers?
Yes, immediately. And that's going to be the biggest thing that everybody notices. There's just going to be less spot volume. There's still going to be the loads that always end up going spot, the ones that are one-off, the ones where there's a day that gets pushed out in shipping, maybe there's too much volume, whatever, the things that naturally pop up. Even in 2019, when we had 3% tender rejections, that's still 3 out of 100 tenders. That stuff's going to be there. But now what we have, where there's 20 to 30% rejection on tenders, that's going to disappear immediately. And these loads are still going to be there. If we look at the OTVI, and even if we want to take an accepted tender index, there is still a massive amount of freight that's moving through the country right now. But you can tell that it's going spot or it's going contract because tender rejections are down, even though tender volume is up. And then if we just look at spot rates, they're also down. Now, they're not going to fall out of bed because the contract rates have been repriced so much higher. But now if you're running that load out and you're that shipper, you're paying 5-10 cents lower than the spot, whatever, you don't care. Those loads have to go. You want to get that rate on file. You want to get that load out the door. So if it's a contract rate that's 15% higher year over year, so be it. And that's going to keep a floor underneath spot prices, but spot loads by volume, those are going to start to dwindle and dwindle rapidly.
Yeah, I was gonna bring that up. The OTRI, isn't that an indication that this normalization or this calming down of the market, as you would say, and not falling out of the routing guide is already starting to take effect, right? Because that's what that's measuring, is stuff falling out of the routing guides and hitting the spot market, putting upward pressure. That coming down is indicative of it's implicating that there's fewer volume coming out of those routing guides hitting the spot market and driving up price, right?
Right, because it's landing at primary or secondary or tertiary because the rates are now higher. We've tried to warn going back to August and September of last year about this. Get used to the scenario where volumes are high and rejections come down, but prices remain high because everything's going to get repriced higher. That's the only solution to this. Unfortunately, the freight market is very similar to an agricultural commodity where there's almost seasons and there's time that takes to bring more capacity online. We'd love to go out and just buy a truck and have it ready tomorrow, but that's not the case. And we had seriously strong orders in November and December for trucks, but those aren't showing up until summertime at best. So until then, the only way to solve the spot market crisis is to push contract rates up higher. Now, to answer your question in a much longer format, and I apologize for that, Kevin, if you're a broker and the bulk of your business is spot, that's going to go away. And if you want to keep running your business and you want to keep running loads, you're going to have to get involved in contract and you're going to have to get involved competitively.
If we look at aggregated volumes, we take the contract and the spot, put them together, overall freight volumes heading into the really second half of 2021. Do you expect any blips and a fall in overall load volumes in the second half of the year? Do you think it's going to be a strong volume year all through?
I think overall it's a strong volume, but my personal opinion is the second half of 21 is going to look a lot different than the first half. I think from now until, call it 4th of July, it's going to be a lot like the second half of 2020. You've seen a number of retailers and businesses say it's a focus point for them this year to rebuild inventories. Obviously, there's only one way to do that, and that's to move the goods around, whether they're imported or they're coming from warehouses and DCs to stores. That's going to keep going. That's going to keep freight volumes afloat. Once that inventory rebuild is over with, now we get back into what does consumer demand look like? Obviously, that's a huge unknown, and that's the big question when none of us can predict it. But I think it's very hard to picture a scenario where the second half of 21 looks like the second half of 20 by way of U.S. consumer demand. Call it stimulus, call it working from home, whatever it is, we all bought a lot of stuff. Are we going to keep buying that same level of stuff in the second half of 21? And this is one of those weird things I've tried to point out to people. It sounds very funny to say, but if things do go back to normal and we get a return to everyday life, that's less freight moving through the network. Because if you're spending your money going on vacation, going out to eat, going to the movie theater, those service dollars soak up a lot of dollars that could be spent on tangible goods. And it's a very easy scenario to walk through. If you think about it, if you go out to a restaurant, you and your wife go out to have dinner, it costs X amount of dollars. If you spent that same amount of money at the grocery store instead, those two have very different impacts on freight because $100 at a restaurant goes one way and $100 at the grocery store is a lot more stuff.
Absolutely, 100% right. And that mix is what mix stays there and what mix doesn't, right? As far as e-commerce, and a lot of that will keep pressure on final mile more than it will anything else, right? I mean, if you start,
and that'll do some pressure on freight too. If you think about it, if we have that shift, and now we have a different freight pattern inside the network, does this look less and less of a pull from LA? And then now we need to shift capacity away from there. That stuff doesn't happen overnight. It takes a while for the trucks to migrate, especially if they have to go all the way back over to the other side of the Mississippi where more than half of the country lives. That takes time. And that disruption creates spot market activity, but it's not going to look anything like what we saw in July, August, or September of 2020. I don't know when we'll repeat that type of spot market volume. I won't say never because 2020 has proven anything is possible.
Yeah.
Yeah, it definitely has. Thank you so much for your time today, Kyle. If you haven't seen Kyle on LinkedIn, his Monday updates are phenomenal. And Rhonda here in LinkedIn says, "Thank you for the quick detailed clips on LinkedIn with Sonar graphics. I enjoy learning all this important stuff." So Rhonda appreciates it as well. And how does our audience reach out and contact you on LinkedIn or through email?
You find me on LinkedIn, or the easiest way is www.k-ratio.com.
Thank you again.
Thanks, guys.
Always a pleasure, Kyle.
Thanks, Kyle.
Yeah, the
it's
second half of
interesting, Kevin.
2021 is going to be interesting. I keep
Yeah.
on talking about that myself. Is that mix shift from tangible goods to the services that hopefully we all get to enjoy again. And you know what? Who needs two swing hinges, right? Are you going to build another swing hinge? You know, I mean, you just need one.
No, that was one of those projects you do once just to prove you can do it, bro. I'm not doing that again. No, but I get what you're saying. So the interesting thing that it leads my brain to is, okay, is second half of 2021. So then do the contracted rates lose a significant portion of the ground that they gained this year?
They would probably have to, but I know someone else that we can ask that question. That's a great opening question for Chris Seeds, who's a sales director over at Bridge Logistics. How are you doing today, Chris?
Good. It's a pleasure, fellas.
Hey, Chris. Great. Nice to see you.
Yeah. Let us know a little bit about Bridge Logistics and what your take on the freight market is right now.
Yeah, sure. Bridge Logistics, we're a third-party, family-owned 3PL here based out of Cincinnati, Ohio. We've been around for about 14 years. We specialize in truckload freight here domestically, predominantly in the Midwest. But we really like partnering with shippers and helping them get a better understanding of, not just what's going on in the market and how we can impact each other together, but how this industry is adjusting and changing and how we can change together.
Good stuff. So, Chris, we were just speaking with Kyle Lintner from of K Ratio and looking at the dynamics between spot rates and contract rates have caught and are above spot rates, right? And what that does to it. Are you seeing any of that? And what's your thoughts on that?
Yeah, first of all, Kyle's a hard act to follow, so I'll do my best here. But I think he hit the nail on the head for the most part. There's one thing about this, the market as a whole here in logistics, and that's what really makes this job fun, is that there's always going to be a huge amount of volatility. How much volatility? That just depends on what's going on in the economy and what kind of pandemic's hitting at this time, or what kind of recovery stage we're in. So I definitely see the trend. I think that you're seeing more and more freight being accepted by contracted carriers because more shippers are willing to pay that higher rate because they want the stability. I think that shippers are they don't want a repeat of what happened at the end of the year last year, so they're willing to accept those higher rates. Now, how long is that going to last? I think you're going to have a season of several mini bids that transpire. And, kind of what Kyle was saying earlier is, that second half of the year, or maybe the third quarter, starting in the third quarter, who knows what that environment looks like as we transition from a season of, buying goods to being able to spend money on services. But at the end of the day, I think that you have consumers that have been receiving stimulus checks have a decent amount of savings built up. I think that there's a significant level of stickiness amongst several industries, especially the grocery industry, as Andrew Cox was mentioning earlier, and they're going to continue to buy differently than they did pre-pandemic. And I think that hopefully the new administration can get some sort of infrastructure figured out, and there'll be a lot of spending there, which will cause a lot of movement within the industry. I think that housing, new permits which are high right now, are going to show up in the latter half of the year as these homes get finished, and they need to be filled with appliances and anything else you would need to furnish a home with. And I think with all these things combined, I think you're just going to see an enormous amount of demand consistent, and I think it's going to move. Even if the consumer demand resides, I think that you're going to still have a number of factors that play into goods needing to be moved across the country.
So Chris, we mentioned Kyle's weekly update that he does on LinkedIn. You have your own show and your weekly updates that you do, What Not to Miss with Chris. this latest episode, what were your main points that you want everyone out there, shippers, everyone in the market to know about?
Yeah, and the reason I make that video in the first place is to educate customers and anybody in the industry that wants a better understanding of what's going on right now and how what's transpiring now is going to impact the future in the logistics industry. But I would say right now, the inventory levels that we're seeing, the low level of inventories we're seeing right now, and the pull forward that's happening in order to get those inventories back to where they need to be, whether that's a shift from a just-in-time mentality to a just-in-case mentality, because nobody wants to be, no importer wants to be in the situation they were in the beginning of the year, and how that's affecting transportation domestically, to the backup that we saw at the ports, and how that's affected and is going to affect the remainder of the year. You have, I think I touched on it in my last one, not to miss, with Chris, and it was around Chinese New Year blank sailings. I think you were only going to see 2% of sailings as opposed to 20% of sailings, and that's huge just to get caught up on their end because of all the factors that are affecting Asian manufacturers and container shortages on their side. So there's just a number of different things going on right now, and I tried to keep those videos to a couple of minutes. But if you noticed on this last one, I think I went close to 15 minutes long, just because there's so much going on. It's crazy time to be in this industry. It's exciting, and we love educating customers, prospects, anybody, carriers, that's willing to listen to what we have to say. And it's just a really fun time to be here.
It's interesting you're talking about stocking and restocking inventory levels, and it kind of goes into the theme that we're always talking about going into 2021. It kind of reminds me of a situation we might face early in 2019, with all the pull forward demand from tariffs coming in 2018, and a severe overhang and overstocking, right? What do you think the risk is for building up those inventories too far and having maybe some of that mix of spending from tangible goods to services, and all of those factors kind of coming together in another perfect storm?
Well, I think that the landscape is a little bit different than it was back then. I think that this year has proven that movements of supply chain for importers and manufacturers is incredibly difficult. So as much as you want to move away from manufacturing in China, it's very challenging, and it takes years and years and years to establish other lines of supply chain that can maintain certain shippers' level of growth and demand. So I think that this pull forward is to avoid any type of pandemic-like situation we experienced before in the past, and nobody wants to be undersupplied. They want to have that product on hand just in case, even if that means paying more for warehousing and really just a doomsday type mentality. So I think it's a little bit different landscape than it was back in 2019. So I think that I don't think you're going to see that type of history repeat itself, but it's definitely something to keep an eye on.
Yeah, I think you're right, Chris, and to just hit on that a little bit more. I agree with what you're saying there to a certain degree, and the other part, Kevin, that I would just put on top of that is the environment that's driving the demand and the consumer spending is a little bit more sure-footed, unfortunately, than it was than the reasons for that overstocking, et cetera, that happened 2018 into 2019, right? We do have the vaccine coming out, but we have, new strains of the virus coming out, unfortunately. And even if everything goes great, the majority of the people who are going to be running around traveling and stuff aren't getting this vaccine until August,
No, I agree. I can see those dynamics coming together. I don't know if they'll come together and we'll have this huge overhang or not, but it's something to consider, certainly. Yeah.
It is. It's definitely something to keep an eye on. And that's one thing, give it a shout out to Sonar here. That's one thing that, Sonar lets us be able to do and be able to forecast and educate our customers, and keep them in the loop about trends that we're seeing and, how to react accordingly to those shifts and if they're going to happen or not. So, Kevin, great point. Good thing to keep an eye on. And luckily, Sonar lets us do that.
That sounds perfect, Chris. Thank you so much for your time today. What day of the week do you usually publish What Not to Miss with Chris?
I try to put it out on Mondays. I depending upon my schedule during the week, that can be harder to do than other times. But usually Friday or Monday is when I put it out on LinkedIn.
And you can just find Chris Seeds on LinkedIn. Probably the best way, right?
Yep. And if you want to know more about Bridge Logistics and what we do here, bridgelogisticsinc.com, or you can reach out to me directly, cseeds@bridgelogisticsinc.com.
Thank you very much, Chris. Always a pleasure having you on the show, and we will see you next time.
See you, fellas.
Thanks, Chris. Interesting conversation. We could go on forever on that, but we're just going to have to live life and find out what actually happens.
Oh, we will, but I always love these heavy episodes of domestic truckload freight, right? It's just a great market. It's very volatile. It's always entertaining. Sometimes in a good way, sometimes in a not so good way, but it's always entertaining, which is fantastic. You know what else is entertaining, Michael Vincent?
Nick
Sales
Austin.
and marketing.
Oh,
well, Nick Austin is too, but sales and marketing. Let's plug sales and marketing. The summit that we have coming up Thursday all day, 9 o'clock to 5 o'clock. We're going to have all kinds of sessions on freight sales and marketing and freight logistics, freight tech, marketing to drivers, growing your brokerage, scaling up, content marketing, the whole gamut. So join us there. Dooner and I will be hosting it with Put That Coffee Down. And it's going to be a fantastic show. We've already gotten record-breaking registration levels for any of our virtual events so far with this. So come join us on Thursday. And
I know I registered just when I found out you were going to be on the live desk. I registered. That's what my hook was.
That's fantastic.
Hopefully you'll beatbox this time. You refused to do it last time you were at that live.
Well, I didn't refuse to. I just didn't really understand what a beatbox was.
Is that what it was? Okay.
I'm not a musician like you and Dooner.
I
don't have any musical abilities whatsoever. But
you
guys did some music yesterday on What the Truck, didn't you?
Yeah, we absolutely did. Yeah, Jose Socorro from Mid-States Manufacturing played his saxophone. That's the second time he's on playing his saxophone on What the Truck. It was really good from Central States Manufacturing. We also had Ryan Droege, which I would pronounce it Droge, but he corrected us. It's Droege, CEO at Relay Payments. They just got a $46 million raise, or $43 million raise they just completed, which was really interesting to talk to him about what's going on there. And Gregory Johnson, COO at Zembles, was on as well, which was really interesting. And one of the things that we're really kind of proud of, and it wasn't really us, it was the audience in the trucking community, talking with Shannon Curry. She's the director of philanthropy and development at the St. Christopher Truckers Relief Fund, Kevin. And you remember we kind of picked up on them last year around this time because live events were being canceled, and that's one of their main raises of money for that fund. And they met their $1 million goal last year, and had her back on, and they've got a diabetes awareness and program this year, and some other health and welfare, wellness, I should say, programs this year as well in the St. Christopher Fund, and are trying to get to 1.1 million this year. So hopefully we can help drive that a little bit. So yeah, it was a great show, and a great one tomorrow as well. Yeah.
It is great. It was a great show. Always a pleasure to listen to that, and you can listen to it on Freightcast wherever you download your podcasts, Apple Podcasts, Spotify, Amazon Music, all of that. You can go register for the Sales and Marketing Summit at live.freightwaves.com. And you can always check out, also Put That Coffee Down, which we aired live yesterday. You can find that on demand or on podcast. Me and Chris Jolly with Rachel Heaps from Transportation Impact, talking about how to turn those no's from a negative to a positive, And while they're always important to collect those no's, because that's when you know that you're about to get a yes with all those
Amen.
no's. So